Well, now time seems like a good a time as any to start. Thank you very much. Thank you, everybody, and welcome to Trending Treasury, the weekly webcast from Arling Close. This week, I'm joined by Dr. David Green, a member of the Strategic Director at Arling Close and a SIPP qualified accountant. And we're going to be talking about the themes for accounts close down this year. Obviously, there's lots of exciting things to talk about. Perhaps not on the face of it as exciting as something like interest rate forecast or something like that, but I think everybody knows that this is an important subject and we'll be able to get down to it. Just before we start, do make sure that your speakers are turned on. You won't be able to hear me if you didn't, but more importantly, that your camera and microphone are off. And if you do have any questions, use the chat box provided. So, David, how are you? Have you had an easy and simple task to log on today?
No, would be the answer, but this is what we expect sometimes, isn't it? It was fine earlier on, and then it's started to go off about 5 minutes to 10.
Yeah, it's always it's been the fun of learning how to deal with home working and all those things, is wrestling with the technology and the fact that it's good and it's certainly improved, but it's nowhere near, I would say, where you'd want it to be relying on it on a day-to-day basis, in my experience anyway. No,
but well, almost. I think it's very good. It's like, but we like moaning, don't we? We like moaning at the trains. When we used to travel around the country, we used to moan about the trains all the time, but actually they were good 99% of the time. And I think this is probably the same. That's
a good analogy, David. So, right. Well, I mean, let's crack on then. Obviously, we close down the accounts every year and produce accounts for local authorities. What do you? I mean, look, every year there are some major elements that we either need to have a closer eye on, or things that are perhaps a little bit different this year. So I suppose the first place to start is IFRS 16. Is it finally going to happen? Every year I joke that there's no need to do much work for it because it'll just get cancelled at the last moment. So the new leasing standard, are we finally going to be looking at putting some transition work together for the new leasing standard?
Difficult question, isn't it? Is this the third year it's been delayed? It's certainly the second delay, if not the third. I think you'd have to start thinking about it when I might not go through the full detail of working out all my starting balances now, on the off chance that, especially if I've done it twice already. But getting prepared, making sure I've got the systems in place, that I know what I need to do, even if I'm not going to go through and do all the work until I'm sort of more certain that we're definitely going to do it. I think that's probably sort of broadly my position on it.
I mean, one of the things that seems to be holding us back from almost sort of confirming it is a little bit of the issues that may be around PFI, whether it's going to be in scope of IFRS 16, whether it's going to be out of scope. If it's in scope, what the impact is going to be, and SIPFA and sort of the other accounting bodies trying to work out what the impact would be. I mean, what are some of the issues around PFI that is sort of it seems to be holding things up?
Yeah, I mean, PFI is broadly a lease, with a big service element on the side. So we account for it currently as a finance lease. So there's no broad reason you shouldn't carry on that way, but clearly they're usually index linked. So but that's quite common for long-term leases to be index linked. So prices going up with inflation, that's something we'll have to cope with on property leases. I think we can manage that on PFI leases as well. That's probably the main thing. A lot of the difficulties about separating finance costs from service costs, we've done all that already, to generate the finance lease in the first place.
And obviously, there's also the point about for authorities that have got a housing revenue account or a HRA, whether there's been a bit of a question on whether that's going to be in scope as well. I mean, what would be the differences there? Why wouldn't we want to put the HRA into scope?
I think this is only about disclosure notes, because I think an HRA lease is almost certainly going to be an operating lease for the council. Could be a finance lease for the resident, but we're not doing their accounts of them, we're doing our own. So because the resident can leave, they're not tied in for the long term into the lease. You're almost certainly going to be an operating lease as the lessor. So it's really about all the additional disclosure notes required by IFRS 16. Generally, people don't tend to disclose operating leases for HRA in their notes currently, so they tend to assume they're not a lease in the minute. And obviously, the definition of lease hasn't changed very much at all. So I suspect really they are. If they were leases before, they should be leases now. And if they weren't before, they shouldn't be now. But I think the change to the new standard has just caused people to think about it again. If you look at housing associations, most of them don't do the leasing disclosures for their tenants, but some of them do. So sort of thing SIFR's thinking about, what do other people do? Do they treat them as leases or not?
So do you think, the housing associations are required to follow a SORP, in the same way that we are? If some of them do and some of them don't, it sounds like there's a little bit of choice or a little bit of discretion for those preparing the accounts. Do you think that it's likely that we'll see a similar level of discretion for local authorities on that?
Could be. I guess it's a question of, for a housing association, that's basically their main business. So there's already plenty of disclosures on rent, income, that sort of stuff. So there's not the need to repeat it in a lease disclosure note. And again, for local authorities, that housing authorities, there's a whole set of HRA statements. So again, they may feel that it is a lease, but the additional disclosures wouldn't add anything because there's already the HRA disclosures. So there's probably some nuances around that.
And there's also the sort of the thorny issue of concession releases, because it seems like we keep saying, we're definitely going to bring IFRS 16 in, and then it doesn't come in. But when we're being told it's definitely coming in, there's still quite a lot of things that are up in the air. We've mentioned DFI, we've mentioned HRA disclosures, but around concession releases, that seems to we still don't seem to have a clear understanding on some elements of that as well.
No, so this is where leases for no payments or very low payments, so non-commercial type of leases, and you probably don't think of it as a lease if there's no payments. But if you're given the use of a building, excuse me, or you give someone else the use of a building for free, should that still be on your balance sheet if you've given it away? Should you recognise it if it's given to you? Clearly, if it's donated asset and you get it full time, you recognise it on the balance sheet. If you only get it for the next 99 years, the next 20 years or something, should that be shown as an asset? There's those type of questions. And as ever in the public sector, there's lots of things that you just don't have to think about in the private sector, because there's all sorts of transactions a private sector body would never contemplate, like giving away its land for free. But public sector, we do it, especially to other public bodies. So yeah. And some of the problems, because SIP for LASAC is the body that writes the code for local authorities, they are very keen to keep things in line with what central government orders for the central government departments. As the FRAB, the Financial Reporting Advisory Board, writes the FREM, the Financial Reporting Manual for central government departments. And because of things like whole of government accounts and also other parts of the national statistics, they want to keep things aligned. So there are times that we've made a decision for local government, and then central government's made a different one. So we've then gone back and reversed our decision in local government. So it's a fraught process for getting these standards pinned down.
Yeah. So if you're a betting man, if you had to put money on it, do you think IFRS 16 will come in this year?
I guess it was only COVID that delayed it this time round. So they thought they were ready with the standard. Although, as I say, they keep consulting on different changes. Yeah, I think unless there's another exceptional reason, which is a bit of a get out clause in it, but yeah, I would expect.
I was going to say, come on, David, put your money where your mouth is. Do you think it will?
I'm going to bet that there won't be another exceptional circumstance, and therefore IFRS 16 will be applied to local authorities. from 1st of April 2021.
There you go. So moving on, from will they, won't they, to something that we do know is going to happen this year is IFRS 9 was brought in a number of years ago, and we've had to deal with a number of changes to the way that we look at financial instruments. And one of the big ways is the movement from a sort of previous regime of sort of past loss, where you only impaired financial instruments if something happened, to expected credit losses, where we have to make an impairment or at least put a provision aside at the beginning of when we first recognise an asset. So obviously in the last year, last year's when we were preparing our accounts, it was a bit difficult to do that because we were in such a unique situation. When you're saying, well, what should we be putting aside in case somebody doesn't repay this loan, is quite a difficult decision when you're in the middle of a once in 100-year pandemic. But we've now got a little bit more data, and especially around things like trade receivables, it could be that we can perhaps start to see a little bit more nuance. But equally with that, there's probably going to be a little bit more pressure on us to get things not accurate, because it is always an estimate, but there's going to be more pressure on us from the auditors to have something very robust. Yeah,
I think they were probably, auditors should have been a bit more relaxed. The whole process of accounts. At one point, remember, we were talking about not producing statement of accounts for 2020. So in the end, you just let the timeline slip. Recognition that people are under pressure, as either sickness or self-isolation, or indeed finance staff being taken over to do frontline jobs. Fingers crossed that won't be happening this coming year. So there should be a lot more, back to a more robust set of accounts. I don't think we know yet whether they're going to slip the timetable, but certainly I think things like expected credit losses, there'll be more of an expectation that you'll be able to have more of a handle on what they are, certainly handle what impairments have been last year. But yeah, you're entirely right, Stephen. It's only an estimate of what's going to happen in the future. So it's about using supportable, evidenced information. So clearly, information about the past and the current position, but also forecasts for the future, preferably forecasts that you can substantiate. So other people's published forecasts. And some of the stuff from the credit rating agencies is useful there. What might happen to defaults going forward?
One of those things, of course, that we may see a little bit more of an expectation of auditors to work on is that, and coming back to leases, is lease receivables. IFRS 16 requires you to put ECLs in place for those as well. Previously, I think most people have been, I would say, relatively sensible and said, well, the expected credit loss on a lease receivable is relatively small. For a start, it's usually only a very short period of time. Most leases are paid, most lease payments are paid relatively regularly, so it's going to be a small amount in the first place. So you're only impairing a small level of receivable. But also because you can, in theory, take the asset, if somebody doesn't pay you the money back, you can take the asset back into yourselves. That means that the actual loss is likely to be significantly lower. COVID seems to have changed the rules on that though slightly, and this and changed the situation for a lot of organisations, especially local authorities. So, do you think that that's somewhere that the auditors will be pushing a little bit harder on and making sure that the ECLs again are quite robust?
Yeah. So, and just to point out, you're required to do this now. So even though we haven't got IFRS 16, SIP has adopted this impairment losses for IFRS 9 because we've got IFRS 9 in place. Applies to the leases we've got at the minute. The size of the debtor obviously is the first thing. I think this applies to finance lease receivables as well as operating lease receivables. So clearly could be quite a bit bigger number for a finance lease receivable. Size receivable multiplied by the probability of default multiplied by the likely loss given default. Yeah, so the thing with CVA, so a creditors voluntary agreement, is where the people who are owed money by the company together decide that they will take losses of a certain percentage. And it's then, there's a 75% majority of creditors approve a scheme. It's compulsory on all the creditors. And that would include landlords who are owed money. So they may well decide, to cut rental payments, cut debt, and even if you voted against it, you still have to take that. I guess the other thing about also repossessing the asset isn't always the best thing. Kicking a tenant out when there's no other tenant to go in, you're better off getting some money from an existing tenant, quite possibly, than having a vacant property. And again, it's the same why creditors might agree with that on debt. They'd rather get some payments in the future than send the company into insolvency and possibly get nothing. And finally, I guess, yes, you may be able to repossess and sell the asset, but in a depressed market, assets won't necessarily be worth the debtor is, especially if it's early on in the lease. So,
yeah, and of course, you've got the issue that because of the government's moratorium on enforcing your rights as a commercial property holder, for example, there could be significant arrears this year. When we get to when we get to the end of the financial year, that if a lessee, even if it's an operating lease, has only paid a couple of months all the way through 2020 and 2021, you've been assuming that you'll eventually get that money. There's probably if that starts to be a material number in your accounts, again, there's going to be a lot more pressure from your auditors to have a robust number, because the materiality is just going to start to increase. And I think when we talk about commercial property, people think, well, I don't work for an authority with who's done a lot of exciting commercial property investment. But this also applies to local authorities that have got strategic assets in their town centre. If you own town centre assets that you own for regeneration or strategic purposes, that all counts. And this isn't just about the authorities that have gone in for commercial property or debt for yield. I suspect that pretty much every authority in the country has something like this, and he's going to have to deal with that.
Yeah. It's all landlord-tenant arrangements, isn't it? And of course, as well as what we discussed about expected credit losses, there will also be areas where we have agreed a payment holiday, or we have agreed a reduction. So we, for those of you who are our clients, we produced a paper on accounting for payment holidays earlier in the year, so earlier in the pandemic. Maybe we'll circulate that again as we get towards year end.
So moving on to another element, I suspect there'll be a bit more of an expectation and a bit more pressure on this year, and that's equity valuations. Again, a lot of our clients and a lot of local authorities have either a share of a joint venture or a fully owned subsidiary, which allows them to construct housing. Mostly it's realistically, it's most of them are housing companies which are looking to increase the supply of and also the mix of types of housing but we're required obviously to value those, and if we've gone down the route of where we're not bringing them all into group accounts and instead are valuing them on the balance sheet as a financial instrument, there's going to be some quite a lot of scrutiny of some of these valuations, especially after the last 11 months that we've had.
Yeah, and of course there've been a few high-profile failures of local authority subsidiaries, both in housing and energy companies in the year. So, equity valuation is about having a cash flow forecast and discounting it at an appropriate risk-adjusted rate. So, some challenges to the robustness of those cash flow forecasts. In the new world we find ourselves in. And of course, there's the question of getting the risk either on the cash flows or on the discount rate, so not double counting the risk, but also not accounting for it at all. So,
yeah, I think I suspect that if you do your equity valuation based on your 2019 business plan and you don't make any adjustments for the fact that we've had we've completed Brexit and we've also gone through a once in 100-year pandemic, I suspect your auditors might have a few questions for you of why you still think that that's an accurate forecast. I mean, even if it's, if you've got a development company that's developing housing for the local area, just the simple fact that it's very, very likely that your developments have been significantly delayed due to not being able to get men and spades in the ground, or not being able to get the supply of assets, the supply of raw materials through easily. Bottlenecks at the very beginning of the crisis. They'll expect to at least see that there's the delays on those things and the knock-on impact of the discounting of the cash flows. That's even before you get to the risk. So it'll be quite interesting to see the level of detail that auditors want to go into on these things. I mean, my personal feeling is that if you think about the update in 2020 on materiality, by materiality, they didn't change the definition of materiality, but they made it clearer. And I think for us in the public sector, that clarity reminded us that materiality isn't just about money. It's about, would the users of the accounts come to a different conclusion if we looked at these things, if we didn't include some of these things. And I think with high profile collapses, as you put it, or high profile problems that some of these organizations have had, we're going to see a lot more scrutiny, where local authorities, the users of the accounts are, well, the local people, and they're going to want to know and want to understand what the performance of these companies are. And I think, I don't know if you disagree, David, but the auditors will be taking that into account when they choose what to scrutinise this year.
Indeed, and I think we saw an example of that with Lobos. When they became a hot topic, certainly particular local authorities, auditors across the country stepped up the auditing of Lobo loans and the disclosures around them. And those with additional embedded derivatives. Remember, there was a very late, I think CITFA issued something in May, which was backdated to the previous financial year, on how to account for inverse floating Lobos, for example, because it's suddenly become a very hot topic. So yeah, I think whatever's a hot topic in local government, you can expect auditors to focus on that. Even if it's another council's problem, if you've got something similar, they'll want to have a look at you.
I think that's, I have some sympathy with the auditors on that. I think, it's easy to accuse them of just chasing, this is in the headlines, so we'd better audit it. But actually, if at the end of the day it's been an issue elsewhere, I think it's fair for users of the accounts to expect a level of diligence upon similar exercises and similar accounting processes in other organisations. I mean, I don't think it's an unreasonable approach to take from the auditor's point of view, but it will mean that if you sat your wholly owned subsidiary on your balance sheet at cost for the last 3 years, and the auditors haven't really questioned it, I think this may be the financial year where the clock, where the sand in the hourglass maybe runs out on that approach, and they start to say, well, no, this needs to be cost may have been analogous to fair value 3 years ago, but that's no longer the case.
Yeah, undoubtedly, there's companies where cost will be broadly, if you've got a shared service company, something which doesn't own many assets, that's probably, unless it's got a great brand name and it's going to turn out profit for many years, basically it's going to have very little value, and equity valuation might not be worth much. But for anything that's commercial in nature, anything that owns assets which are going to change in value, then the company valuation will change almost certainly, and holding a cost on your balance sheet is probably not the most useful information to users of the accounts. One more thing on here, CITFA consulted last year on whether group accounts are actually useful, whether we should just stop the requirement for group accounts in total. That will obviously bring the need to do more fair value stuff on the single entity accounts, if that is the case.
And so, you know, very finally, I mean, this may be a year where, a bit like last year, we're paying a bit more attention to the events after the reporting period note. I mean, the longer close down period may get us out of that, but certainly I think we those events after the reporting period, you know, if we get in, you know, touch wood, you know, we'll all be vaccinated and things will be good. But if we do have a third wave, or if there's a new variant, we could see quite a big change in some of our assumptions, especially around things like ECLs and equity valuations, and away from more treasury focused things like, you know, building valuations and asset valuations, etc.
Yeah, I mean, that's one of the benefits of the shorter close down period that we've had for a few years, was that there wasn't much time for a post balance sheet event to happen, you know, before the accounts are authorised for issue. Clearly, more risk of that happening through events and through time for events to have effect. Yeah, I guess last year it was obviously difficult with COVID happening so close to year end, and so many unknowns. I mean, in some cases, when things are so completely unknown, it's acceptable just to say we don't know. I think that was a lot of things about the Brexit referendum happening at the end of June, with a 31st of July deadline for issuing accounts. So, you know, it was so soon. All you could put was, we don't know what's going to happen. But you can do that for 1 year, but not in subsequent years. So yeah, and I think we'll probably, by the time you're publishing your accounts in the summer, there'll be more idea of whether will be a wave next winter of COVID and the impact of that.
So I mean, there is no way of getting around it. We are still in a lockdown, and it's likely that these restrictions will be rolled off gradually. So, just as a sort of a bit of housekeeping, I won't be presenting any face-to-face workshops, and I suspect that nobody on the call will be excited to join us at any of them until we're all nicely vaccinated and COVID's a thing of the past. So, how are we intending at Arling Close to service current clients and to assist them with their close down process?
Well, quite helpfully, we've got a slide on the screen there. We're going to run a series of technical Tuesdays. So between half and 1 hour at 9:30 each of these mornings, discussing the various topics there. So capital accounting, financial instruments, and then focusing on those two areas we've spoken on today, the difficult bits of financial instruments, which are expected credit losses and fair values. And then we'll remind ourselves of the new lease accounting requirements that we're expecting to come in April. Yeah, I think, you know, a good way for us to get a lot of people on the call at once, have a talk through what the issues are, get questions through the chat function. This worked quite well. We did our strategy workshops in this type of method, so it seems to work quite well. And these and they'll be recorded and placed on the client area of our website for you to view later.
It's also quite a nice way of doing it, in the sense that rather than asking for the nice you know, full day out of the office, which is perhaps easier when you're doing it face to face. You know, it's easier just to put a nice clear bit in the diary. It's harder when you've got well, in my case, cats and dogs jumping all over me when I'm working from home, and some colleagues and some clients have children that or deliveries at the door and all of those sorts of things. Having a good, you know, as you put it, you know, half an hour to an hour session where we can sit down, but it doesn't take a full amount out of the day, is probably the best way to do it. And a way we'll do more of these things going forward. Just a reminder that these will be open to Arling Close clients only, and that, as David said, they'll be put on the Arling Close website for you to watch. If you can't manage to get there at 9:30 on a Tuesday, you will be able to watch them again. Or even if you come along, you'll be able to watch them. You'll be able to watch them and be reminded of the exciting interest that you've received. So just before we have had a number of questions. So before we come to the questions, I suppose just one last element is just to talk about some of the ways that Arling Close can assist over and above Technical Tuesdays. Obviously, hopefully everybody on the call who's an Arling Close client knows their technical contact. And unfortunately, we're not a law firm. We don't start a little clock when you ring us with a query and then stop it and then bill you. It is all included in your main Treasury contracts for those of you who've got those retainer contracts. So please do feel free to call any member of the technical team with queries, or drop us an email. And if you haven't actually got a technical contact, your usual Arling Close contact will be, if you email them, they'll be able to forward it on to one of us, and hopefully we'll be able to get back to you as soon as possible. Unless it's a very tricky one, and then it might be a little bit of a delay. But if it's a basic contact, always welcome a conversation. But there are a few other services that we've got this year that might assist, and that we've been doing over the last couple of years. David, I don't know if you want to quickly just rattle through them. I'm aware of time.
Sure, yeah. So as Stephen said, really all this stuff on expected credit losses, fair values, it's all included for your Treasury instruments. So it's your surplus cash investments and your borrowing. But for anything non-Treasury, it's where we would make an extra charge. So expected credit losses on loans made for service purposes, so loans to subsidiaries, loans to charities, etc. And then fair values of those loans, and also the fair values of your subsidiary companies, etc. That's where we make an extra charge for. We've also got, I think people have found this quite useful in the past, as a pre-audit accounts closedown service. So if you can find a window after you've prepared your draft accounts, but before they go off to be audited, we can review the capital finance elements, the financial instrument bids, check everything looks sensible, and maybe point out any inconsistencies, any obvious omissions and mistakes before they get to the auditor. And people ideally you'd like to send a nice clean set of accounts to your auditor, I think. That's what says we need to book a day. Clearly, we can't have everyone do it in the one day between the statutory dates. So best if you can book your days, and we make a relatively small charge for that one as well.
Great. Well, thanks very much. So I think now's a good time to move on to the questions, because we've actually got a few that a few more than I was expecting. So the first one, it's not really a question. It's just when we were talking about the IFRS 16. Heather Salmon has just posted an update saying that it's applicable from the 1st of April 2022. But obviously, what we were talking about was that would be certainly what we're expecting, because there are obviously transitional arrangements for 2021. So if we do end up, we're expecting it to happen in 2022. Our question was, well, will it be delayed further to 2023? Because this year, for this set of accounts, for the 21 accounts, we would expect, the auditors were probably expecting some provisional arrangements and some transitional work to be done, such as working out the balance sheet impact of the new standard, etc. But yeah, I think Heather has posted the most recent update that we've had in the question is with 2.5 months to go, will we receive another one? So I think we can deal with that one. We've also got a question on about ECLs. Are ECLs required under IFRS 9 for operating leases, or is the loss provision for these calculated through a different route?
Yeah, operating lease receivables. So like any other trade receivable, so it's a short-term debtor on the balance sheet, it needs a expected credit loss calculation. And you can adopt a policy of whether to do lifetime or 12-month ECLs for operating lease receivables, separately from any accounting policy on other types of receivable. So yeah, it's definitely required. Although, as I say, it's probably going to be a much smaller number than a finance lease receivable.
Great, thank you. The next one is there's been a few comments around what the expected deadline for compiling a draft set of accounts for the external auditors. I mean, I think the assumption up to now has been that that we'll go back to the usual timetable unless there's an update. And up to now there hasn't been an update. So what would you be expecting one, or would you be acting perhaps on the assumption that that we're going to be going back to the usual tighter timetable?
Yeah, so it was I think at the very sort of start of the pandemic, when they introduced lots of changes to law, they changed the legal deadline for local authority accounts to be published for 1 year only. So as the law stands at the minute, we're back to the original timetable. It's only in England for draft accounts by 31st of May in England. That could, of course, slip again, but that would need new legislation. So this is probably, the government will be looking to see on all sorts of areas, things like delayed elections. There'll probably be a whole, if the pandemic is going to last longer than Easter, I imagine we're going to have a whole raft of extra legislation, delaying accounts, delaying elections, all that type of stuff. My best guess is that they're hoping we'll be in a much better position come 31st of March, and if not, things won't be normal, but they'll be much better than they were last year.
Great. I'm just looking through, and I can't. If anybody does have any more questions, I'm aware we've run over our usual time a little bit, but I think this is a good opportunity to ask questions. So if there are any questions, please do just drop them in the chat. We'll just wait a few more moments. I've also had a comment from Ian Duncan that there's an ITC on the HRA tenancies and leasing standards issued by SIP-LASAC. I think that is the case, isn't it, David? Yes,
yeah. Just points out they're still unsure quite how they want to deal with this. So yeah, seeking views. I think SIP is aware that the standard HRA tenancy agreement is different in different parts of the country. So it's possible there will be different rules in different administrations as well. But yeah, I go feeling it's really about the disclosures is the key issue here. I don't think there's any question that an HRA tenancy creates a finance lease, because all the reward is particularly with the tenant, but the risk of the tenant departing is with the local authority. So risk and reward hasn't all been transferred, which is the requirement for a finance lease.
Right. Well, the only final question was from somebody who wasn't able to make it to the beginning of the session. I'd just say that we won't be emailing any slides because we didn't have any. But what you can do is watch the whole thing again when it's uploaded to the website, and which normally happens within 24 hours. So if you check the website, the Arling Close website client area or the main areas, then you'll be able to watch the whole thing again. And perhaps some of you who watched the whole thing enjoyed it so much that you'll be eager to listen to me and David talking about accounts closed down. You'll be able to do that too. So that'll be up on the website tomorrow morning. We haven't had any further questions, so I will bring us to a close. So all I'll say is thank you all very much for joining us, and thank you, David, for giving the benefit of your expertise. Next week, we'll be speaking to Nick Dunbar from Risky Finance. He'll be talking to us about the risks of municipal finance and the risks around local authority debt, which will be very interesting because I suspect he's got some quite challenging views to the Arling Close House view. So it'll be definitely be a good one for those of you who either are lenders into the local authority space, or if you're a borrower. So that really should be 100% of you, I should expect. So yeah, do make sure to follow us on Twitter and LinkedIn, where you'll get regular updates, and the Arling Close website. If you check on the main areas of there, we have published insights. I mean, there's a very good one written this week by my colleague Nick Keeling that I can recommend you check out this week. So I'll just thank everybody again for joining us, and thank David, and say goodbye.
Yep, goodbye everyone.